Welcome to The Explainer. Today, we're going to clear up some major confusion around two words that sound super similar but are worlds apart when it comes to your finances: restructuring and refinancing. And trust me, getting this right can be the difference between sinking and swimming with your debt. You know that feeling, right? That squeeze you get when you look at your car payment or your mortgage or maybe a business loan. It can honestly feel like you're trapped. But the good news is, you're not. There are ways out. And today, we're going to explore the two main escape routes. So, here's our game plan for today. We'll start by talking about that trapped feeling. Then, we'll look at two very different solutions: what we're calling the lifeline for when you need a hand, and the upgrade for when you're ready to level up. After that, we'll put them side by side, share some pro tips so you don't make costly mistakes, and then help you figure out your best next move. Okay, so picture yourself at a crossroads with your debt. The decision you make right here is, well, it's a big one. One path, restructuring, is all about getting immediate relief so you can just stay afloat. The other, refinancing, is a strategic play to boost your financial health for the long haul. It's really about survival versus optimization. That is the core difference we're talking about. Let's dive into path one. We're calling this one the lifeline. And for a really good reason. This is the option you look at when things have gotten tough and you need a way to catch your breath, financially speaking. So what is debt restructuring, really? The easiest way to think about it is like this. It's a direct conversation with your current lender. You're not out shopping for a new loan. Nope. You're going back to the original source and saying, hey, the deal we made isn't working for me anymore. Can we change the rules of the game to make this doable? The most important thing to get about restructuring is that it's almost always a defensive move. It's for when your cash flow has seriously dried up and making those monthly payments feels next to impossible. Your lender might agree to help you out by lowering your interest rate for a little while, or maybe stretching out the loan term to shrink your payments. They might even let you pause payments for a few months. Why? Because it's better for them than you defaulting. This is the step you take to avoid something much worse, and it gives you that critical breathing room to get back on your feet. Now, let's shift gears and look at the second path. This one isn't a lifeline at all. It's much more of a strategic financial upgrade. It's a move you make from a position of strength, not stress. Debt refinancing is a whole different ballgame. With this, you're literally taking out a brand new loan, usually with a totally different lender, and you use that money to pay off your old loan completely. Poof, it's gone. You're essentially swapping out your old clunky debt for a new, shiny, better one. And right here is where you see the huge shift in mindset. Refinancing isn't about desperation, it's all about opportunity. You're playing offense now. Maybe interest rates across the board have dropped since you first got your loan. Or even better, maybe your credit score has shot up. You're not just trying to survive the month, you're actively looking for ways to improve your entire financial picture. Okay, lifeline versus upgrade. We know what they are. But the real question is, which one is right for you? To figure that out, let's put them head to head and make this choice crystal clear. This table just lays it all out so perfectly. Check out that credit impact row. That's fascinating, right? Restructuring can actually hurt your credit score because it tells future lenders you've been in trouble. But refinancing? It can actually boost your score if you do it right because it shows you're responsibly managing your money. I mean, they're practically polar opposites. If we boil this entire thing down to its simplest form, the decision really hinges on one fundamental question. Are you currently unable to make your payments? If the answer is yes, that's a massive sign you should be looking into restructuring. But if you are able to pay and you just have this feeling you could get a much better deal, that's your cue to start exploring refinancing. All right, so just choosing your path, that's only the first step. Now you gotta walk it without stumbling. So let's talk about some pro tips for a smooth journey and, just as important, the common pitfalls you really need to watch out for. So you're leaning towards the upgrade path? Awesome. But don't just jump in. You gotta follow the roadmap. First, go look at your current loan agreement and check for any sneaky prepayment penalties that could cost you. Then, and this is huge, shop around. Getting quotes from different lenders is the single best way to know for sure that you're getting an amazing deal, not just the first one that comes along. Now, for restructuring, the process is less about filling out applications and way more about negotiation. You have to call your lender, clearly explain your hardship with proof, and then propose a solution. And that leads perfectly into this quote. I know it says companies, but it's just as true for you. Having your financial paperwork in order, your bank statements, your proof of hardship, it's non-negotiable. It shows the lender you're serious, and it proves you're still a good person to work with, even when you're asking for help. Okay, time for some warnings. First, hidden fees can absolutely ruin a good deal, so you have to read the fine print. Second, watch out for the term extension trap. This is when a lender offers you a lower monthly payment, but they do it by stretching your loan out for longer, say from 3 years to 5. It feels cheaper every month, sure, but you could end up paying way more in total interest. And that restructuring stigma? For an individual, that's a mark on your credit history that basically screams, I've had financial trouble, which could make getting new loans a lot harder down the road. So we've navigated the paths, we've gone over the pro tips and the pitfalls. What does this all mean for you? What's the one big thing you need to take away from all this to shape your financial future? It all comes back to this one simple but really powerful idea. Are you in choppy waters right now and just need a lifeline to stay afloat? That's restructuring. Or are you sailing smoothly and ready to hit the boosters with a powerful upgrade? That's refinancing. At the end of the day, real financial power isn't about having a ton of money. It's about knowing your options. And now that you really understand the difference between a lifeline and an upgrade, you can take a clear-eyed look at your own situation. So which path is going to shape the future you want? The choice is yours to make.